So far, it's been 6 years of me investing money into the stock market. And I've made 5 times the money that I wanted to make or I thought I would make by this age. And I learned everything from what's a hedge fund, a mutual fund, an index fund, an ETF, individual stock picking, or the magic formula. I've learned all this stuff, but I can remember a point in my life where I knew nothing. I knew nada. So in this video right here, I'm gonna break things down in a way where a fifth grader can actually understand it. Now, my goal here is not to sit here and tell you, hey, mutual fund equals definition that I found on Google, because just knowing the definition does not mean you actually comprehend how things actually work. So the goal is you walk away from this video knowing all this stuff better than I do. That's the goal here. So if you're interested, watch this video until the very end. On top of that, also destroy the like button. On top of that, also subscribe to the channel and hit the bell so you get notified. Now, let's get started here. And the first thing I really want to explain in a simple way is the stock market. Whenever you think about the stock market, this is important because everything as far as hedge funds, mutual funds, index funds, ETF, it all falls in within the stock market, and it's all just different ways to invest into the stock market. So if you don't understand that, none of this stuff is actually going to make sense, okay? So whenever you think about the stock market, simple. Think about eBay or like a marketplace. And what's happening there is businesses are selling themselves, okay? So the idea is, instead of me trying to buy Apple for $2.65 trillion, which I don't have, right? Well, Apple says, let's just issue out a bunch of shares, a bunch of slices of our company, and allow regular people like Tommy and me to go ahead and put money into these companies. That's what happens. And whenever you buy a small slice of the business, that's called you buying a share. And whenever you buy a share and you actually own it, you're called a shareholder. And your right as a shareholder is to be able to vote on important stuff with the business. And also, if they issue out profits like a distribution or, for example, a dividends, you get a piece of that also. That is what investing basically is. And they do this in order to raise money. That's what businesses basically want to do. But just off of this one idea, if business wants to raise capital, makes a public initial offering to allow us to invest into it, you have a bunch of different jobs. You have financial analysts, you have the brokers, you have all of these factors, and that's where the entire world of hedge funds, mutual funds, individual stopping, where all this stuff actually comes from. Just from a business trying to raise capital by selling pieces of itself to the public. That, my friends, is the stock market explained in the most common sense way I can come up with, okay? Now, let's start at the very beginning. I'm going to break down 6 things here, okay? You're going to have individual stock picking, mutual funds, hedge funds, index funds, also ETFs, and lastly, you're going to have the magic formula, a new way to actually invest money to try to beat the market. It sounds ridiculous, but it's true. Don't worry. I'm going to break everything down here, okay? So the very first thing, guys, is going to be an individual stock picker. Whenever you hear someone say, I pick stocks, I am an individual stock investor, I buy shares or whatever, that just means that this person grabs their money and basically picks the companies they want to pick to invest money into. So they're going to say, hey, I want to buy some Apple stock, some Microsoft stock, some Tesla stock, some Dell computer stock, whatever company they want to buy, they put their money there and they invest money into it. And by the way, fun fact here, the stock market started back in 1792. A very long time ago, this whole thing has been happening. And ever since then, that's what people have been doing. Picking stocks, picking a company here and there, and putting their money into it. However, this is the least efficient way to put money into the market because most of these people, they make 2 to 3% on average, and most of them are losing money every single year. That's the big problem here. But the people that know how to understand a business, value the business, invest based on the business value and not because John said it's going to go up. People like Warren Buffett, they make the most money because they are also stock pickers. So stock pickers be successful, but you got to know what you're doing. So advice, learn accounting, learn finance, and dive deep into understanding how to evaluate individual stocks, okay? Read a book. It's called The Intelligent Investor by Benjamin Graham. There is your nugget. Now, the second product is going to be, for example, mutual funds. People get confused here, but it's fairly simple, guys, okay? Whenever you hear about a financial product, it always starts by having a problem and then they're making this product to solve that problem. So mutual funds started back in 1924. A lot more recent, okay? Less than 100 years ago. Well, 98 years ago, I think, or so. But the idea is, a mutual fund is, imagine this. You have a bunch of individual investors and they're not having much success, but they believe that professional investors can make them a lot more money. So these professional investors go ahead and they make their own company. And with this company, me, you, your mom, your dad, all of us can buy the shares of their company and pool in all of our money, and they invest that money into stocks, into bonds, into short-term debt, but it is regulated. So they can't buy risky things, for example, stock options, derivatives, and all that stuff. So that's what a mutual fund basically is. It's a company that pools in investors' money, professionals, okay? And they go ahead and pick the investments and they have one goal, which is to make their investors money. But again, because they are, for example, professionals and they're supposed to be better than you, well, they're going to charge you a fee. And this fee is often known as, for example, the expense ratio, operational fee, or, for example, maintenance fee. And it can be anywhere from 2% to 3%, sometimes 1% at the lower end. But the idea is that these professionals are supposed to do better than the average market by itself, or better than you can by yourself. That is what these mutual fund investors basically tell you and what they want to do. The problem is that investing and professional investors are not like doctors, okay? A doctor, certified, licensed, experienced, you know he can do what he wants to do, right? His job or her job. But when it comes to an investor, the professionals more than often do not do better than the average investor just following and tracking the market. That's the problem. So you end up paying someone to do something you can do yourself a lot better by doing really nothing. So I don't recommend mutual funds. But if you want to buy some, you have Vanguard to invest into with them. You have Fidelity. You have a bunch of companies out there that allow you to put money into a mutual fund. But again, it is expensive and it's not my style. But at least you understand now exactly what a mutual fund basically is. Now, this one's going to be interesting here, because my friends were talking about hedge funds, which started back in 1949, a few years later. Now, I always see this happening where you have something start up, but then you want to do something different, and people that are very wealthy want to get into it, but they want to be exclusive, so they kind of just pull in their rich money and they put it in one place. That's what a hedge fund basically is. Imagine a mutual fund, but it's privately held. And usually they don't take just me, you, your mom, and your dad. No, they take people with a lot of money. And it's usually privately held. Most of the time, privately held. Now, what it means is that by law, you have to be an accredited investor to actually invest money into a hedge fund. That means you either have a net worth of a measly $1 million, or you make at least $200,000 a year by yourself, or $300,000 a year if you are married. So basically, you need to make a lot of money, or you need to have a very high net worth. And the idea is that unlike the mutual fund, they're not that regulated as far. So they can go ahead and invest, for example, into stock options, into derivatives, and into more riskier investments. Now, the goal is that if you have a lot of money and you want to put money with them, they're going to do a lot more of the things and riskier investments to give you a higher amount of money or a higher return. That's the idea. So think about it, for example, like, again, company grabs investor money, but these investors are basically very wealthy, grabs this money, pulls it together, and these professionals are going to do better than they possibly can by taking on a lot of risk to make a lot of money. But because they're very smart, they're going to go ahead and make the most money. And you hear about it all the time. Tommy, this hedge fund made this much money, or this mutual fund made this much money. But those are managers. The managers that manage these funds, sometimes you can have a very smart manager, a very good manager, but it's not guaranteed. And it's not guaranteed just because it had, for example, a good run that when you hop in is going to continue to be a good run. That's the problem. It's like finding a needle in a haystack. That's the big risk here. So when you think about a hedge fund, think about, for example, a exclusive mutual fund for the wealthy or the accredited investors to take on more risks than is actually regulated for us to actually go ahead and take. Now, before you say, Tommy, well, this sounds like these wealthy people have access to investments that we don't have access to, and that's why they're wealthy. Don't really think that, because these investments, they're very risky, very gambly, and they're not something that I want to participate into, even if I can participate into it. Not my game, not interested. And by the way, usually you have to have, like, just to get started investing with them, they require, for example, like maybe like $500,000, $1 million, $2 million. Well, for example, with a mutual fund, you can have, for example, $3,000, $1,000, $500, and boom, you're in the company, you're investing with them, and all that stuff. Okay, a minimum investment is required to invest into this stuff, but $500K, $1 million, it's a lot of money. It's a very expensive, exclusive gambling club to actually join, if you ask me. Again, not my game. I had a friend that worked there, and he was like, I don't like this, but he made a lot of money though. So yeah, as just an employee. Now, index funds, 1975. Now, a big problem was happening, okay? Because mutual funds and hedge funds, they all have their fees and their crazy minimums, but index funds, they solved that problem because what they did was very different. And by the way, it was actually, the first index fund was actually made by John C. Bogle, that guy over at Vanguard. Vanguard's an investment company, Google it. That guy is amazing, taught me so much stuff. So what an index fund basically does is, it only wants to be average. It wants the average return, and it doesn't want to be selling back and forth because that's taxes and that's expensive. And it doesn't want to hire a bunch of smart people to do this and that because it's also expensive. So usually they have a much lower expense ratio. I'm talking about like 0.01%, 0.04%, and that's a lot less than 2 to 3% with the mutual funds, okay? Now, here's the big thing to drive this point home. When you picture an index fund, think about this, okay? Tommy, I think the technology sector in the stock market is gonna do so well in the next 10 years, okay? And you're like, I wanna invest into it. And all you can do by yourself is pick, for example, 1 to 10 stocks, you buy them and you hold them, right? As an individual investor. Or you might go ahead and hire, for example, a mutual fund and say, hey, well, we are smart, so we're gonna pick the tech stocks we feel like they're gonna do the best, okay? Great. Or a hedge fund where they do whatever they want to do and they say, well, we think the tech stocks are gonna go down tomorrow, so let's do an option there, whatever, blah, blah, blah. That's that. But an index fund says, well, we agree with you. So let's form an entire fund based around all of the technology stocks in the stock market. So instead of buying one, they pull in all the money and they buy the entire sector, the whole thing, or the portion that they actually want to, as far as all of those technology stocks. And once they buy those tech stocks, guess what? If the tech industry does well, that entire basket is going to do well because you have all of them. So you're going to get the average overall return of whatever the tech market actually does. That, my friends, is an index fund. It's indexing. And by the way, an index is a collection of names or whatever. So think about an index fund as buying, for example, all the stocks in a certain sector and trying to track that performance, not trying to beat it, outperform it, no, just trying to track it and do exactly what it's going to do. That's the idea. So whenever you hear someone say, oh, I invest into the S&P 500 index fund, well, the S&P 500 is an index of the 500 largest companies in the US. So when you buy the index fund, right, you're buying those 500 companies, which in return is going to give you the same performance as the actual 500 index. That's the idea, okay? Pretty cool stuff. Don't get confused. Think about it, for example, as you have a basket full of stocks, not just one or two, or having someone that's smart pick them for you. You just buy the whole thing, and that way you don't got to worry about it. That's the way I think about it, so I never forget. Now, let's move on here, because again, every time we have a new product, It's because there's a problem. And there was a problem when it came to index funds. So that's where they created ETFs. ETF stands for Exchange Traded Fund, and they started back in 1990 or the 1990s, okay? Now, the idea is, again, we have a problem here because although index funds are great and they tend to make more money than mutual funds and hedge funds and all those things combined, okay? Well, they also have a cost for you to actually start investing with them, usually like $500 or $1,000 for each fund. So if you want to have 6 funds like I do, well, 500 times 6, that's $3,000. That's a lot of money, right? So not all of us have that much money. By the way, though, if you have a retirement account with Vanguard, they'll waive this whole requirement. But if you have, for example, a taxable normal account, you have to have the requirement, and it's a lot of money. So the ETF market or the ETF product, what they did was they created a product that's traded in the actual stock market. And they also track indexes or, for example, certain mutual funds. That's the idea. So it's the same thing, the same fund, same index, but the idea is now it's traded in the stock market. So now this initial minimum to invest is basically gone. And the price is not based, for example, on the NAV value, which stands for net asset value, which, by the way, forgot to mention this, but indexes and mutual funds, they only give you a price once a day after the market is closed. And the price is not based on the stock market itself, it's based on what the net asset value basically is of those investments in that fund. But when you have an ETF, it's not based on that. It's based on, for example, well, the market might be up, might be down, demand, supply, all this stuff, or there's a war, something happens, it might crash, might go down. It's not based on those concrete facts. So when you picture an ETF, picture, for example, you're tracking an index, you're tracking, for example, a mutual fund, but the big difference is that this investment is in the market, so thus it can be subdued by, for example, market volatility. That's the idea, okay? That's the big difference. And by the way, I own a lot of index funds and I also own a lot of ETFs. But I wouldn't buy ETFs in the short term because they are volatile and they can go up and down, even though they're diversified, but they still waver when it comes to market volatility. So yeah, I have index funds when it comes to my retirement accounts, and I also have ETFs when it comes to my normal accounts, okay? That's the idea, but it's for the long run. All this stuff is for the long run. Now, by the way, remember that tech example I used for buying the whole tech sector? Well, if you want to buy that index fund, you can if you want to, and the ticker symbol is VITAX, but that same, for example, index fund also has an ETF form of it, which is, by the way, VGT. So if you don't have the money to invest into the index fund and you want to invest into the ETF version of it, you can invest into it. So it's an alternative to basically just investing into indexes, okay? That's the idea. So there you go. So for every index fund, there's usually going to be, for example, an ETF that basically tracks it, and it's also in the market and allows us average investors to go ahead and invest into it if we don't have the money for the minimum investment. That's the idea. Now, lastly, what you have is a magic formula, and this book was actually published in 2006 right here, okay? Now, the idea behind this book was simple. It was to say, well, if the whole fad now is just to track the market and build your own like index fund and have like a bucket of stocks, all this stuff, why not buy a bucket of stocks that are probably going to be undervalued and are going to beat the entire market? That's the idea behind the secret formula. And it has two aspects. You buy a company with a high earnings yield and also, for example, a high return on capital. That's for another video, and I have a full video on it. The link is down below. It's more complex, but it's a way to not just track the market, but to outperform it in a very passive way. And that's interesting. But overall, if you ask me, Tommy, which way would you go? Individual stock picking, mutual funds, index funds, ETFs, hedge funds, or magic formula? I tell you what I do right now. I do index funds and I do ETFs. If you want to copy my investment strategy, the answer is the link is down below. When you click the M1 Finance link, it shows you my exact investments. And all of those ETFs also have their own index funds. So there you go. Boom. All right. And the company I invest with is M1 Finance. But for retirement, I do Vanguard. There you go. Thanks for watching, guys. As always, any questions? I hope this video broke everything down. It might have been a little long, but the goal was so you can leave understanding how everything works. Thanks for watching. Like, subscribe, hit the bell so you're notified. Up here is another video, and over here is my face. Click and subscribe. Thanks for watching. Long-term team officially out.